So the second speaker of today's session on economics is Professor Yizhou. Professor Yizhou is an associate professor of finance at the Chinese University of Hong Kong Business School. His primary research interest focuses on information economics, fintech, and entrepreneurial finance. He contributed an article to the Palgrave Handbook on fintech and blockchain, and has published his work on top journals like Journal of Finance, Review of Financial Studies. He was invited to be the guest associate editor of Management Science and several Grant Institute. He received a PhD in finance from Stanford University Graduate School of Business and MA from Peking University. So yeah, without further ado, Prof. Xiao, the floor is yours, and I think you can look at the lady. She will give you a signal of the time. Yeah, thank you.
General question in the economics, financial market in general, but somehow you can find some evidence and answer in the blockchain world. Okay, so to give you a very brief start, so this is something finance people or economics in general are quite familiar with, but maybe the tackle audience are not that familiar with. This is something we call basis risk. So what happens is that there's a financial derivative contract. If you're trading in the blockchain world, you might know it's called future. So in general, it's designed as a hedging tool, but if the market is perfect, basically you can use future contract to do very good hedging. But in reality, it's not always the case because the market is not perfect. There's always some friction. So what I show you is that this is possibly one of the most competitive market, one of the most liquid market in the world, which is a treasury future contract market. But still in this market, still because of some friction, so some mispricing in the future contract. So in another word, the future price doesn't move one in one hand with the underlying asset, which is a treasury bond here. So given this is a risk, so if you're doing hedging, this is the additional risk you have to bear with, which you don't like it. And even for this most liquid market, you can still see the deviation is quite strong. So this is the general term, what people call the basis risk. So this is a very important part. And this can lead to a lot of market problem, especially during some special time. For example, there's a very famous London Metal Exchange, the nickel crisis, if you still remember, a couple of years ago, because there's a price spike in the fundamental nickel price. So it's also moved the future price and resulting in a huge liquidation issue there. So as you can see, this price basis risk is serious in the traditional financial market. And for the Bitcoin market, or you can also take a look at Ethereum future market, it also exists. So this is a 3 months Bitcoin future market basis. Of course, we need to make some assumption when we compute the basis price, but you can see it actually quite fluctuate over time. So this is the risk that if you want to do hedging, or if you want to do speculation as well. Okay, so what we find is that there's actually interesting asset, which is what people call the perpetual future contract. So this contract don't really exist, or at least not actively trading in the traditional financial market. So because in the standard future contract, you have an expiration date. When I say 3 months, means 3 months later, it can expire. When it expires, the future contract will be settled. The contract will disappear and the payoff will be realized. But for the perpetual future contract, contradictory to the standard definition of the future contract, it doesn't have an expiration date. It always exists there. So what happens is that when you have observed the perpetual future contract, which is quite unique in the blockchain trading market, actually you figure out the basis risk is very, very small. It's significantly lower than any other future contract you can find in the market. So what's unique here is that for the future contract, because most of the time the payoff realized in the final day, right? So you settlement the contract, you realize the payoff. But because for the perpetual future contract, you never expire, you never settlement. So what happens is that people introduce a mechanism called funding payment. So it depends on different trading platform. They have slightly different rule, but in general, every couple hours, for example, 8 hours, they will compute what's the price difference between the future contract and the fundamental asset. For this case, it's Bitcoin price. And then the one who benefit from the mispricing need to pay a fee to the one who suffer from the mispricing. So if the future contract is overpriced, then the one who take the long side, who buy in this contract, need to pay a fee to the one who sell the contract. Okay, so that's a payment, funding rate payment structure. So to give you one example, so I would just make the example very extreme. So suppose in the first day, the price perfectly moves, so there's no mispricing. But on the second day, there's a large price drop in the Bitcoin. Of course, I wish I could buy Bitcoin when the price is 1,000 US dollar. But suppose there's a big drop, so there's a big shock in the market, and because there's a trading, the friction in the future contract market, actually you can observe there's an even bigger price drop in the future price, which is mispricing. So this is the basis risk. And for the standard future contract, typically you can observe large magnitude of mispricing. So here's actually 200 US dollars. And later, because there's no big move, so the price still continue. But if you take a look at the perpetual future contract, what happens is that first of all, the mispricing, the basis risk is very low. So in the reality, what you observe is that it's very small. So here it's only $2. And also as a mechanism, because we have $2 mispricing, so continuously the one who, here the one who benefited this is the one who sell the future contract, so take a short side. The one who need to continue pay money to the long side in order to shrink the mispricing. So this is how the mechanism works. Okay, so actually this is not something new, surprisingly. Because if you read the Nobel Prize winner, Robert Shiller, he is an economist at Yale University. In 1993 GF papers, he has a paper basically saying, hey, we should design a contract called exactly perpetual future contract to solve some illiquidity problem and provide a certain reasonably good hedge. But surprisingly, after the idea has been brought more than 3 decades, only blockchain market, financial market actually has this active trading. So this active first real world experiment to let us say the old idea brought by Rob Shiller, whether it works or not, and what's the potential mechanism behind this. Okay, so in the blockchain market, I think I don't need to speak too much, but they introduced first by the BMax in 2016, and later it becomes very popular, and now almost all the major Bitcoin exchange has this perpetual future contract trading, and I will show you later that it's now becomes a dominating instrument for people to trade. Okay, so we are not the first paper, given this such a popular tool trading in the blockchain world. We are not the first paper to talk about that. Actually, there's quite a few people already. But our paper has a special, different focus. We try to focus on how it actually solve this speculation trading noise shock and how to minimize the risk that could potentially put on the participant in this market. Okay, so first of all, we have some data. So basically collect data from the most popular exchange. And what happened here is that there are some minor issues that the perpetual future contract can actually not trade in the US. Because the perpetual future contract is not approved by the SEC, so there's always some legal concern. So even though you can see from, for example, Coinbase, they provide the perpetual future contract and it has a huge trading volume, but if you're a US citizen, you cannot really trade them directly. Of course, you can invest in some third party and who can trade on this. But as you can see, in terms of million US dollar trading volume, the trading volume, the current trading volume for the perpetual future contract is way larger than the standard future contract. Okay? And this is a timeline. This is how the major platform actually start adopting the perpetual future contract and other standard future contracts. As you can see, CME, which is an institutional hedging place, you can see they never introduced perpetual future contract. Okay, and this is the trading volume. I have to say there's some missing data issues. So the spot trading volume is heavily underestimated. So the right number should be roughly 20% of the total trading volume. So we will update the picture later. But the main message here is very clear. So after 2016, once you start introducing the perpetual future contract, very quickly, it becomes a dominating instrument trade in the future contract market. As you can see, there's some increasing part. That's because CME just introduced the future contract for the Bitcoin, and it's an institutional trading place, so you take a quite significant fraction of trading. But for the other platform, you can see the perpetual future contract becomes the dominating one. And if you take a few popular platforms as BMax, as you can see, after the introduction in 2016, it takes almost 100 share of the trading volume in the future market. And for the Kraken, it's roughly the same idea. So you get the idea that after introduction, it becomes extremely popular in the market. And also in terms of liquidity, you can see. So this is the first picture. We take a look at the Kraken. The first picture is about the daily trading volume, and there are two measures. Those are economics, market microstructure people use to measure the liquidity. As you can see, they're all good. Okay, and also you may wonder, hey, because they have a huge trading volume, so it's a more liquid market, so you have more liquidity. It's natural, right? But then we just pick specific type of Bitcoin future, perpetual future contract, which has roughly the same trading volume with the standard Bitcoin future contract. As you can see, the perpetual future contract still have much better liquidity performance. Okay, this is the picture for the BitMax, but it's roughly the same. Okay, so given that, what you can observe is that the perpetual future contract becomes very popular, and at the same time, it has much lower basis risk. So it's much, much less compared to standard future contract. So next, we're going to have a very simple model, try to explain what's going on there. And this is a model with risk-averse speculators. You may wonder, you know, maybe they're not that risk-averse, but it's not really important. It's just a parameter we show. We can allow the speculator and not risk-averse at all. But there's a market maker who are actually risk-averse. Market maker can be risk-averse for many reasons. For example, they don't want to have hold large position because there's always inventory cost and inventory management issues. So they are sort of risk-averse, as in the literature. And the asset, underlying asset, we just model them as a follow Brown motion. And the trade going to occur to the different belief. So basically, as you can see, we implicitly say this is a casino. People have different belief where people speculate here. And we're going to specify two different types of contract. The first one is the standard future contract you observe in the general financial market. Another one is the perpetual future contract we observe in the Bitcoin market, which will compare them in terms of how it affects the price, the trading size, and the return or cost. Okay? So to give you an idea, underlying the Bitcoin, you can see about Bitcoin, this is the price movement. So this is the drift term, which is GT. This is the major disagreement comes from. And there's a shock. Okay? And we have two different types of contract, future contract. The standard future contract will have a delivery day, right? 3 months later, I need to settlement the contract. So the T will equal to 3 months. And there's a funding rate delta. So delta basically every time, simultaneously, I find what's the basis risk, what's the price difference, what's the mispricing, and then one side need to pay to the other side. Okay? So the standard future contract, the delta is equal to 0. You don't have to pay to the other side during the contract, but you have a finite settlement date. But for the perpetual future contract, basically T equal to infinity, you never settlement the contract, but you have a positive funding rate. Okay? And for the speculator, there's a total population. You can think about this as the size of how many people want to trade, want to speculate in the market, and have a mean variance utility. Of course, as I discussed before, it's not crucial. You can simply assume that risk is neutral, don't care about risk at all. And the main assumption is that they think they have a term. They have a term return. The drift term follows a mean reverting process. So basically, you can think about the sentiment, right? So if you have a high sentiment, you think it's more likely to increase, the price kind of more likely to increase in the next few days, but gradually your sentiment is going to go down, right? So it's a mean reverting process, okay? And for the market maker, it's risk averse. And for the market maker, they believe that they don't believe anything about sentiment. They just think about this kind of continued growth as the drift rate R. So the belief difference is the GT. So basically, this explains what's a belief difference, and that's why some people want to buy and some people want to sell in this market. Okay. So we can solve the model. I won't bother you how to solve the model, but it's a very standard solution in the economic model. So what's interesting is that this is the position, okay, for each investor. As you can see, this is the investor belief, right? If your belief difference, if you have more disagreement, you have more trading. Because one person thinks the price is too high, one person thinks the future contract price is too low, you are naturally trade with each other. So the belief, the big difference the belief is, the bigger trading volume could have. And also, this is risk aversion, right? If you're more risk averse, you are more conservative, you are less likely to engage a large amount of trade. And this is a risk, right? So this is the one risk is the underlying price. Another risk is your belief change. Okay. So the price, so this is the future price. ST is the fundamental price. And the second term is basically the basis risk. The basis risk can be decomposed into 3 parts. The first part, again, is belief difference, right? The more different belief, the more speculation going to happen, the more likely it's going to push the price deviate from the fundamental one. And also, it's a risk adjustment, right? So the more risk averse the speculator is, the less likely they're going to push the price far away. Of course, if you have a very risk-neutral market maker, that means it doesn't care about inventory costs at all. If he see any mispricing, he's going to correct the mispricing, then this goes to zero, right? And another one is a risk factor. Basically, it's how the shock can happen, okay? So as we formalize the formula, we can conclude a few conclusions. We can reach a few conclusions. The first one is that the basis risk can increase if there's high market maker risk aversion. That means the market maker doesn't have too much capacity. They really care about inventory costs and so on, so they cannot really correct the price, okay? Or the speculator don't care. Don't worry about the risk at all. They are very optimistic. They are very easy to jump in and trade more. Okay? And also the basis risk can decrease if you have a high funding rate. It's very easy to understand, right? Any mispricing, you have to pay a certain amount of them back to the other party, so that will reduce your benefit from trading. And also, if you have a short horizon, that means because the price can converge very soon, so you don't want to have a big basis risk. Okay? And also, if your belief can converge very soon, right? You are very optimistic today, but your optimism gonna cool down very soon, so you are less likely to engage larger amount of trade. It's very supernatural. Okay. And we also conclude that, first of all, given the perpetual future contract, actually all the market participants like perpetual future contract. What does it mean? That means all based on their own belief, both speculator and the market makers think they are better off if they are using perpetual future contract. Because that's a better way, that's a good way to exploit the disagreement in the belief. Okay? And also in the perpetual future contract, you can have lower price impact. That give the sellers the same shock, the basis risk can be much smaller. And also because there's a much smaller basis risk, from market maker's perspective, it's less risky to hold a large proportion, right? So in that case, they're gonna have higher trading volume in the economy. They can also have a higher open interest. That can explain why the perpetual future contract becomes so popular in the crypto market, okay? And the conclusion here, the basic idea here is that the market participants, they have different beliefs, they want to trade, but they only want to betting on the fundamental price change. They don't want to betting on the additional risk, which is the basis risk here, okay? And we have some other interesting results. The first result regarding hedging, or in other words, speculation. The first result that if there's a no time discount, okay? So there's no time value money. What happens is that basically both type of contract is irrelevant. They're the same, okay? Here, the fundamental idea here is the following. So here is the actual two different types of risk or cost occur here. For the standard contract, the risk or the cost here is there's a basis risk at the beginning when you formalize your position in the future contract. Also, when you need to settle down or you need to quit your position, liquidate your position, there's a basis risk and the ending period of that time. So you have two different types of settlement basis risk. But if you start with perpetual future contract, you face the initial basis risk, right? And when you enter the market, there's an initial basis risk. But also, during the time when you're holding this contract, you have to continuously receive or pay the funding rate. So in that case, you have a funding rate risk there, okay? So when there's no discounting in this model, actually they cancel each other, so it's become irrelevant. Of course, when you introduce discounting, we show that if the PSI is sufficient high, means the settlement will cool down sufficiently quick, or the hedging period is sufficiently long, then the perpetual future contract becomes a dominating one. The reasons are the following. So first of all, if I have a high PSI, means the sentiment, the investor, speculator sentiment, gonna converge, gonna cool down very quickly. That means the future funding payment gonna drop in very fast, right? So you don't discount too much about the future funding payment. And the second one is that if there's a very high hedging period, that means you will continue, if you hold the perpetual future contract, you continuously receive the funding payment in the long term, right? But you know, because of the time value of money, the same amount of money you receive 1 year later is much less valuable for today, right? Because of the time discounting. So in that case, the long hedging period basically implies there are more discount funding payment in the long-term future. So in that case, you find the perpetual future contract actually is a dominating one, okay? Given that the last result is very, very interesting, because if you think about funding payment mechanism, one natural conclusion would be, hey, we should have very high funding payment so we can almost sure kill most of the basis risk, then the market is better, then my hedging risk is lower. This is not the case. Actually, there's some internal solution. You may not necessarily want a very high funding rate in the market. The reason is the following. Again, when you introduce perpetual future contract, we're holding for perpetual future contract, you have two different types of risk, right? The first one is your initial basis risk. When you enter the position, there's a basis risk at that time. The second risk is that because you keep on receiving or paying the funding rate to the other side, so you have a funding repayment risk, okay? So it depends on the two risks, the idea of two risks depends on psi times K. Psi is how quickly the investor sentiment or the disagreement gonna converge, right? And the K is the period. So psi times K basically is a measure about during your hedging time, expectation, how many up and down sentiment cycles will be, right? So if the number of demand cycle or the disagreement cycle is a lot, it's very many cycle, and you can think about it as a law of large number. That means in the end of the day, the basis rate is not a big issue, okay? But in that case, you have a lot of up and down during that time. That means you are facing a lot of payment risk because sometimes you need to pay them more, sometimes you pay them less. So in that case, the high psi times K will suggest a low basis risk, but at the same time, they're going to increase the funding payment risk. So it's not monotonic issue, okay? So given those three results, we can conclude that in the market, if we introduce the funding payment system, actually can help reduce the basis risk, but it can implicitly introduce another risk, which is called what we call funding payment risk. Okay, so the optimal funding rate is not necessarily the higher the better. You have to find some balancing point. Okay, so before I conclude, there are two pictures just to show you what after you introduce the funding rate, what could happen. So this is to say, if there's a big shock on the market maker, you can think about there's a hack or there's a liquidity crisis in the platform. So the market maker who basically accommodates the trading of the future contract has a limited capacity. So the capacity drops a lot. In the standard future contract, because the price impact is very big, you can see there's a big drop in the future price. But compared to the blue point where if you adopt the perpetual future contract, because of funding repayment still helps you a lot, so the drop's not that big. And also after the drop, the basis risk of the volatility of basis risk is actually much smaller. Okay? And for the wealth, so who is gonna earn money? So in our model, we implicitly assume market maker is the correct one. Market maker understands the true mechanism, while the speculator has a wrong belief. Okay? That true sentiment to some extent. So as you can imagine, after the drop, the market maker, on average, they're gonna earn more money in the later because on average, they're the one who with the correct belief, right? As you can see, so here the market maker earn much more money later. And what's going on here? Why is this the case? This is because in the perpetual future contract, because the basis risk is lower, so the market maker give the same capacity, they are willing to offer more position available for the speculator. So in other way, the speculator can take a higher leverage ratio, but because on average their belief is incorrect, so in that case, on average, they're gonna more likely to lose money compared to the standard future contract. So in that case, on the one hand, the introduction of a perpetual future contract reduce the basis risk you can observe in the data and increase the trading volume and open more potential position for the future contract trading. But on the other hand, it's not necessarily good for the system because by lower the basis risk, the market maker can take a higher position. That means the speculator gonna take a higher leverage. So in that case, the speculator gonna more likely to be liquidated because you take a higher leverage, you're more likely to be liquidated in the market. Okay, so to summarize, so our paper, basically, first of all, we document some empirical evidence to show that the perpetual future contract is very dominating in the crypto trading market. And also we developed a model, try to analyze there's two potential risks there. The first one is the basis risk, which is put in good control by the introduction of the perpetual future contract, but it implicitly introduces another risk, which is funding payment risk. So the optimal funding rate is not necessarily the higher the better. So we hope that we can put this evidence to suggest that maybe for the other future contract market, trading in the traditional financial market, they should think about introduction of funding repayment mechanism there in order to control the base risk. Okay, that's everything we have. Thank you.
Thank you very much. I think we have time for 1 or 2 questions. Any questions from the audience? Let's see.
I'm wondering, in your market, do you consider this time-varying market? Because basically, I saw your user-determined version tries to capture these control policies, right? So then, but I think in most of the financial market, it's time-varying. How do you capture these time-varying features in your model?
Yeah, that's a good question. So first of all, I think the model here is not to give you exactly quantitative analysis. It's more about qualitative analysis. Because when you write down model, when you make an assumption that by definition is wrong, right? So here, I think our main message is that, first of all, the introduction of funding repayment mechanism, I think that's a key in the perpetual future contract setup, is a good way to control the basis risk. We don't really need time varying risk to show that. The second one is to basically say, hey, it's not necessarily just good part, because it also introduce another potential risk, which is called funding payment risk, can affect mailing activity in the market, which for both main point we try to show in our model, I think we don't really need time varying or time invariant risk there. Okay. But if you want to quantitatively, or you want to put the model into practice, right? You want to build a trading strategy based on the model to some extent, you have to think about time varying risk. That's definitely a big issue in the asset pricing literature. Thank you.
Okay, thank you. Okay. So, yeah, if there are no other questions, I think we will thank the 2 speakers for their wonderful talk again for this session. And I think Prof. Wang will deliver the, yeah.